You've paid off your credit card, built up your emergency fund, and now you're ready to invest. But you don't know the difference between a stock, ETF, or mutual fund? Let's start with stocks. Welcome to the investing basics. A stock is a small piece of a company that you can buy in something called the stock market. Love Tesla or love Starbucks? You can literally own a small piece of the company by buying something called a share, aka a stock. Right now, one Tesla share is going for about $333 USD, and Starbucks about $87 USD for one stock, aka one share. So, how exactly do you make money in the stock market? Well, the better a company does, its share usually increases. For example, if you bought one Tesla stock for $350 and that company increased in value and the stock price raised by 25%, it would then be worth $437.50. And if you were to sell that share back into the stock market, you would have made an $87.50 profit. The more shares you own and the higher it increases, is the more profit you'll receive if you're able to sell it at the right time back into the market. However, the key to investing is allowing your money to grow in the stock market over a long period of time. For example, say you bought $1,000 worth of Tesla shares in 2015. In 2025, those shares would now be worth about $25,000 because the Tesla share has increased so much over the 10 years. Now, here are the pros and cons of investing in stocks. The first is that there's higher returns if you're able to pick the right company. For example, if you had picked Tesla back in 2015, there are no fees to buy a stock. You get to pick the companies that you invest in, and some even pay you to own their shares, which is called dividends. The cons are that you actually have to research the companies you're investing in to see if they're actually going to be profitable and if those shares are going to increase. There's also higher risk because you don't know if that company is going to do well or do bad over the next couple of years. There's no diversification. You're kind of putting all your eggs in one basket when you invest in one company or maybe only five companies. And it's easy to panic sell if that company takes a turn and its shares decrease significantly. So now that you know what a stock is, stay tuned for part two, where we're going to talk about ETFs.